In the Philippines, cooperatives hold billions in pooled capital, acting as direct financial lifelines for millions of people. For many in the agricultural sector, these institutions are the primary economic engine funding the next harvest. That financial footprint extends deep into the cities. Urban cooperatives underwrite the daily operations of the transport sector, financing the vehicles and protecting the livelihoods of thousands of jeepney operators navigating the streets. When you aggregate this massive volume of member capital in one place, the risk profile spikes. Without rigorous oversight, those pooled funds become highly vulnerable to toxic mismanagement, internal fraud, or catastrophic loan defaults. To protect these assets, Republic Act No. 9520 dictates a specific legal remedy. Every cooperative is legally required to appoint a strictly independent cooperative external auditor, a highly regulated examiner accredited by the state. These auditors put the institution through a mandatory 5-phase gauntlet. Passing this intense sequential scrutiny is the only way a cooperative can secure its annual certificate of compliance and keep its doors open. Validating the health of these institutions requires a mathematically ruthless timeline of investigation, stripping away assumptions to expose the true financial reality underneath. The gauntlet begins with Phase 1, which actually targets the auditor instead of the cooperative. Before looking at a single ledger, examiners must legally prove their absolute independence. This requires a background check confirming they have zero family ties to key officers, extending all the way to the 4th degree of consanguinity. They must also clear a strict mandatory rotation limit. An external auditor is barred from signing a cooperative's financial statements for more than 5 consecutive years, forcing a 2-year cooling-off period to prevent cozy relationships. Once cleared, Phase 2 begins the risk assessment. Auditors scour General Assembly resolutions and Board of Directors meeting minutes. Their goal is to verify that major transactions, like large external borrowings or capital expenditures, were actually authorized by leadership. They test the cooperative's credit underwriting controls against a framework known as CASA, the Codified Approving and Signing Authority. This checks if management actually follow their own internal rules when approving and dispersing cash. If the individuals controlling the money lack ethical competence or bypass governance systems entirely, the numbers on the balance sheet cannot be trusted. Phase 3 is the fieldwork stage. Auditors move in to interrogate the raw data, focusing heavily on the loan portfolio's aging schedules to calculate the portfolio at risk, or PAR. This diagram shows how aggressive that metric is. Under the PAR framework, if a borrower misses an installment by even a single day, the entire outstanding principal balance is immediately flagged as at risk. Once a loan is marked past due, the cooperative faces a mandatory regulatory penalty. They are forced to book an allowance for probable losses on loans, essentially setting aside hard capital to cover the anticipated default. As you can see here, the penalties scale with time. If a loan remains delinquent between 31 and 365 days, the cooperative must provision an allowance equal to 35% of that loan's value. If a cooperative suffers chronic defaults, these mandatory allowances compound rapidly. They act as a direct deduction, violently pulling down the institution's regulatory net worth. And the final penalty leaves no room for error. For any loan past due for more than a year, the provisioning requirement hits 100%. The entire loan value is legally recognized as a total loss. To make matters worse, auditors strictly verify that interest income is not being artificially accrued on these past due loans. Income can only be recognized on a strict cash collected basis. This aggressive credit audit strips away optimistic accounting practices, forcing the cooperative to confront the actual, unvarnished solvency of its operations. Assuming the cooperative turns a profit, Phase 3 also mandates a strict mathematical review of how that net surplus is distributed, governed directly by Article 86 of the Cooperative Code. This visual breaks down the legally required slices of the surplus pie. First, a minimum of 10% must be diverted into a reserve fund vault. This locked capital exists solely to absorb future operating losses. Next, a maximum 10% slice is carved out for the Cooperative Education and Training Fund. This portion is strictly split down the middle. Half stays local for training, and the mandatory remaining half is remitted outward to an affiliated federation. Finally, the remaining surplus is distributed. At least 3% flows into a community development fund for social projects, leaving the final distributable balance to be paid out to members as interest on share capital and patronage refunds. By enforcing this rigid math, the statutory audit forces cooperatives to build a fortress of reserves, prioritizing the long-term survival of the institution over the temptation of immediate payouts to members. With the fieldwork complete, Phase 4 initiates the exit conference. The external auditor sits down with the board of directors to present their findings, including any adjusting journal entries required to fix accounting errors. The auditor also conducts a check for subsequent events, verifying if any pending legal cases or major loan settlements happened after the balance sheet date that might alter the financial picture. Then comes Phase 5, the final verdict. The auditor issues their opinion. If management refuses to book the required loan impairment losses calculated during fieldwork, the auditor is legally bound to issue a qualified or adverse opinion. The last hurdle is procedural but rigid. The complete audited financial statements package must be digitally uploaded into the Cooperative Assessment Information System, with hard copies submitted to the Regional Regulatory Office before the unforgiving April 30th deadline. Surviving this sequence of tests proves that the pooled capital is secure. It ensures the cooperative remains a verified, trustworthy engine for community prosperity, rather than a hidden liability waiting to break.